Welcome back. Not recovering for the market too much as we've been telling you, and here's just a quick run through on what's happening with Asia. Many markets are actually slipping a bit more. The Kospi is down 2%, the Taiwanese index is down about 1.5%. A couple of other Asian markets as well are under pressure. So let's see how the day progresses. Up until now, it's been edgy kind of trade for us. Yesterday, of course, was an outright disaster for whichever market you looked at: equity, bonds, money market. Subir Gokarn joins in to talk about all that. Subir, good morning. Good to have you on the show. Since when we last spoke, it's been a steady downward spiral for the rupee, and the question a lot of people are now beginning to slowly ask is whether the macros and the currency setup are resembling some kind of currency crisis for us.
Well, I think when we look at what happened last week, it was precipitated essentially by the same set of factors that did yesterday's damage. That was the hint or the signal from the Fed that the QE would be rolled back, and in fact then 2 days ago that signal was confirmed, it was made explicit. So you really have to look at this as part of the overall adjustment, both before the announcement and after the announcement, to the new liquidity scenario that will emerge once the QE is actually rolled back. So as people have been saying, there is certainly an overshoot element in this particular adjustment, where all global portfolios will first sort of take stock of what the new liquidity scenario will mean for them, and then there will be some reallocation which will lead to some sort of normalization. Now the question is, what do you do from a policy perspective to ensure that when that normalization takes place, some of those funds are going to come back into your markets? And I think that's the challenge that both we face as a policy, our policy establishment faces, and to a large extent other emerging economies as well.
Morning, Subir. Last couple of years, this problem was there. I mean, the current account deficit was always large, but we just had the comfort of the liquidity, global liquidity, actually putting us some kind of a plug on that. Do you think we can do something on the policy front quickly over the next few weeks, which can tell global investors they don't need to take money out of India in their reallocation? Or do you think this global phenomenon will hurt us anyway?
That's the key. That is the key. I think, when it comes to taking specific steps to stem the flow, people will start getting a little tempted to impose some kind of control or the other, some control on outflows, some control on trade. I think we need to resist that, because these can have very negative long-term consequences, particularly if this process of adjustment is essentially a short-lived one. But when the money starts to get reallocated, as I believe it will, what we've done in terms of credible, concrete actions to narrow the gap, I think, are going to be very critical. So we talked last time about the gold issue, about the oil issue, about the minerals issue. All of these are, I think, pressure points on the current account which can be reversed. At least credible steps can be taken to signal that these pressures will be eased over time, not immediately, not overnight, but at least over a period of time. I think that's very, very important. So there is some news about a meeting on the 1st of July to take stock and to sort of put out a time-bound action plan. I think that will be a very critical point at which the signal of commitment and credibility should go out. And if that is established, if concrete time frames are set, if reasonable actions are proposed, when the reallocation happens, I think that does provide something of a platform for a normalization to take place. But if that doesn't happen, clearly then the pressure of the current account deficit will be seen as a much more persistent and permanent pressure, and that can have consequences for the currency beyond the immediate future.
The other thing which people have started debating is what flexibility the Reserve Bank has going forward now to reduce rates in a scenario where imported inflation because of the rupee will go up and the US bond yield has started hardening quite significantly. But do you think the elbow room is vastly diminished now compared to what it was maybe even a month back?
Well, the elbow room is partly a function of the exchange rate. It's also partly a function of what happens to commodity prices. Now, clearly with the liquidity reversal, the rollback, Along with other asset classes, we should expect to see some correction in commodities, because there is a general perception that the reason why oil prices are so high, even at this point in the business cycle, is liquidity, is that it is an asset class. And so if there's a rollback there, then that may to some extent offset the currency dynamic. If the currency readjusts once global portfolio allocations normalize, then there may be some room, but both of these factors obviously are going to play a role, and they are moving. They are both moving in somewhat different directions right now, so there is an offset factor there. But overall, if commodity prices remain where they are for whatever reason, and the currency continues to slip, then obviously the inflationary consequences of the depreciation have to be taken into account.
What did you make of what happened in the bond market yesterday, Subir? Trading was actually halted. There was a big pile-up in terms of selling,
right.
a big accumulation over there. Yields, really turned turtle. Do you think there's a big reset happening in the bond market as well? And where would you say yields could be headed to?
Well, as I said, I'm no longer in the, at least for a while, not in the projection business, so I'm not going to make any forecasts on yields. But I think what the episode displayed was the vulnerability that you have on the external sector when you open up to debt. We saw a very similar pattern, of course, over a much longer period and with greater intensity during the Asian crisis, when the countries that were badly affected had all opened up very liberally to debt flows, and those reversed very quickly. And sort of went out in a flood, and that had a huge impact on both domestic macro parameters and the currency. So we have been opening up on debt. Obviously, there were some compulsions for it over the last couple of years, because other flows were tending to ease up, and we needed the inflows. But when the situation reverses, as we've seen over the last week, those debt flows are the first ones out. So the money that came in over a period of months went out over a period of days, and you get this outcome. That is, the markets, the prices crash, the yields shoot up, and this has a direct bearing on the currency. So, I mean, what is done is done. We can't sort of roll back on that. But I think we've got to be conscious of the fact that when we open up to more risky forms of investment, we have to manage our vulnerability. You can't do this in a situation where the current account deficit poses such a high level of vulnerability.
We talked about this the last time round as well, Subir, but just given the current context, both in terms of what's happening with the bond market, what's happened with emerging market currencies, what do you think should be the next likely couple of steps to attack the depreciation on the rupee? I'm not talking about piecemeal intervention and ensuring it doesn't slip to 60 but trades at 59.50 instead. But what, 2-3 steps do you think are of crucial importance now?
I think the signal that has to come out in terms of, as I said, not overnight, and you're also making the same point, that there's no magic wand here, that you say something and tomorrow flows are going to come back. We have to prepare ourselves for the readjustment, and that means now signaling some concrete steps on the vulnerabilities on the current account. What are we going to do with gold? What are we going to do with minerals? What are we going to do with oil? There will be some short-term measures, obviously, but most of these are going to be yielding dividends if they do over a year or more. But I think it's important to have these plans laid out very concretely. And it's not as though there aren't inputs already available. The gold issue, for example, has been discussed repeatedly at various levels, and there are proposals out in the public domain. So I think it's important to commit to some of these, at least as a start, and then over time, flesh out some more. I think the mineral issue, coal is very significant. Iron ore is very significant. These are caught in judicial action. Government needs to have a plan to work through this, and we can't just assume that this is the end of the mineral economy, that we cannot ever export iron ore again, or we will have to live permanently with imported coal. I don't think we can afford to take that position. So some explicit strategies to reverse the situation, I think, are important, and I hope that over the next, starting July 1st, if that's the beginning, that some of these problems are concretely addressed.
The news that's coming through from New Delhi also, Subir, is that the government will look at a lot of FDI changes in specific sectors. Do you think these kind of enabling provisions will matter much in the situation that global liquidity is in, and that will do anything beyond sentiment to shore up the rupee?
Not immediately. I think FDI, even in the best of circumstances, enabling is important, is critical, but at the end of the day, it's the business environment, the business prospects that bring the money in. So it's important to enable, and there's no question that these things need to be done if they're deemed to be acceptable by the range of stakeholders that are involved. Then by all means, let's go ahead and do them. But let's not expect them to substitute for some of the more difficult structural measures that need to be taken. So it's all part of an approach. They all add up to greater comfort, to greater confidence, and therefore help us to position more effectively for the normalization that is inevitable. But none of them is a solution in itself, and we should not allow these kinds of actions to come in the way of, as I said, the more difficult ones.
Subir, thank you very much for your time, for joining in today.
Thank you.